Hello, clients and friends. This is Craig Llewellyn from U.S. Investors International, and it's my pleasure to present first quarter economic review. At our firm, we partner with clients and believe an educated client is our best client. While we will always try our best to help you when it comes to your finances, we believe that knowledge is power, and one of our missions is to share with clients any knowledge that can better help them make an informed decision. So diving into the first quarter of 2024, it continued to reward investors who stayed the course and enjoyed strong returns in 2023 as the momentum of 2023's year-end rally took another step forward. As you can see from the charts, while the equity markets movements were not in a straight line, they were upward for the quarter. Overall, both equity and bond markets performed well after the Federal Reserve confirmed that the disinflationary trends were consistent and satisfactory enough for them to finally consider monetary easing beginning this year. However, in the last couple of weeks, we have found that given the strength of the economy and inflation is ticking up, that they're now backing down from that stance and maybe one rate cut or none at all for 2024. The S&P experienced its best first quarter since pre-pandemic in 2019. All three major indexes had strong finishes, and both the S&P 500 and the Dow Jones Industrial Average closed at record levels for the first quarter. For the quarter, the S&P 500 returned over 10% and closed the quarter at 5,254. The Dow Jones Industrial finished the quarter at 39,008, adding over 5%. The Fed did not raise the federal funds rate in the first quarter, and they remained in the target rate range of 5.25% to 5.5%. During the Fed's March meeting, it was also indicated that we could see several rate cuts in 2024. But again, in the last few weeks, the data is coming in stronger, and they're now saying they may not be able to lower rates in 2024. And to date, we have not seen any rate cuts, and the recent inflation numbers, again, could extend federal interest rate stagnation. So inflation pressure continued to be a concern as March's inflation results showed a rise of 3.5% from a year earlier. The April reading was 3.8, so it went up a little more. So both months have been an increase from February when the 12-month percent change in all items in the Consumer Price Index, the CPI, was up 3.2%. So these rises causes concerns that we may still not see an interest rate reduction for the Fed at all in the first half for sure, and probably not the second half from what they're talking about here in the last couple of weeks. And we might not experience those three potential rate cuts for 2024. The stock market responded unfavorably while yield climbs on U.S. government bonds, and that's why we've seen in the last couple of weeks the market is now taking a breather and having that we're in the middle of this market correction. So there are a few more scheduled Federal Reserve Committee meetings in 2024, and although it is currently anticipated that rates might go down at some point this year, the Feds remain committed to achieving the 2% inflation rate goal and intends to adjust rates accordingly should inflation pressures have a resurgence. So given everything that's going on, if this keeps continuing, rates may end up going up again. We'll see. And as you know, bonds and interest rates move in the opposite direction. When interest rates rise, existing bond prices tend to fall. And conversely, when interest rates decline, existing bond prices tend to rise. Currently, we still have an inverted yield curve. This means that the short-term bonds are yielding more than longer-term bonds. As of March 28th, the 5-year Treasury notes yielded 4.21%, the 10-year notes yielded 4.2%, and 20-year notes yielded 4.45%, and the 30-year notes reached 4.34%. As of the end of the first quarter, this inverted yield curve has remained longer than the previous record of a 624-day inversion in 1978. While many analysts consider an inverted yield curve as a precursor to recession, we have yet to see an economic downturn, and at this point, it's been just the opposite. We will continue to closely monitor how the Fed's movements and interest rates are affecting bond yields, with the Fed's anticipating interest rate cuts later in 2024, but again, that's anticipations beginning to dwindle. This may narrow the opportunity to get lower risk, high yielding bonds. But safety comes with a cost, and even though interest rates have risen in major banks, are still averaging low interest rates to savers. According to Barron's, the average bank money market rates on April 1st, 2024 were still only 0.6%, and the average 12-month CD rate was 1.95%. While they have increased in the last 12 months, savers are still seeing lower returns. In the brokerage accounts, we can get different CDs that the banks are not doing anymore. It's been an interesting time. Since 2008, 2009, and the pandemic, usually banks will adjust to this shorter rate environment. This time they are not. And so through the brokerage accounts, we can get much better yields 3, 6, 9 months. Once you get 9 months, 12 months, those rates just start dropping down. And we've been doing that a lot for a lot of you. Even ultra short bond funds are looking very attractive here. I don't know if I've ever seen the rates that are going on in those today. So great time for interest rates with CDs, short-term bond funds. We haven't seen this in a long time. If the Fed delays cutting interest rates again, just like they have said they might have to do, or possibly reducing the number of predicted cuts in 2024, which again, they just said they were going to do, or may have to do, this or any other major negative event could adversely affect equity markets. And in fact, in the last couple of weeks, you've seen that. We're not down, market correction is 10%. We have not hit 10%. We've been a little over 5, between 5 and 6%. We may have a little more on the downside to go yet. So and this is very normal in bull markets to see this, especially when we've gone up 6 straight months, starts looking for any negative news. And uncertainty and confusion could also shake the strong investor confidence that's now prevalent. And that, geopolitical event, more negative news that comes out here in the next few weeks on top of the news we just had recently on how strong the economy is. There's just a lot of unknowns ahead, and it's always possible to see a market correction in the near future. This may not be our only one. We think this is nothing more than a market correction. However, as we get to 2 or 3 months out of a presidential election year, historically things get choppy, especially when the election is a close one, like we think this one will be. Most economists predict that should a market correction, a decline of 10% or greater in the price of the security, asset, or financial market happen, it will be a modest one. And we tend to favor that as well. As this chart shows, since 1954, after a first quarter of more than 10% returns in the S&P 500, the second quarter was higher 9 out of 11 times. All those years included pullbacks, which are temporary retreats of no more than 5 to 10% in the price of a stock, or corrections during the year. However, 10 out of those 11 years ended with positive returns with an average of 11%. Coincidentally, the average pullback during the year was also 11%. So please remember, as with all data, this past performance data does not indicate or guarantee anything to the future. The global economy continues to have its share of uncertainty during the first quarter. This year, the U.S. is in the middle of a heated presidential race. Again, just getting this election over with will be good. Long term, it really doesn't matter who the president is. It matters the policies coming out of Congress. There are also key races for the Senate and House of Representatives, and that is what will impact policy and tax law. And again, that'll be much more longer term. So who wins the presidency long term just doesn't matter in terms of the markets. But with all this uncertainty ahead of who's going to take what, and then the tax sunsets next year, there's a lot of uncertainty. There's a lot of stuff up in the air. Uncertainty and unrest within geopolitical issues are also a key factor for equities. As I said earlier, we'll continue to keep an eye on these, how they may affect the equity markets. A lot of things we're watching as we move through the elections and into next year. Although the first quarter of 2024 was positive for investors, equity investment should be viewed with a long-term lens, and short-term movements are still always unpredictable. Now, as always, is a good time to review your investments and confirm they are still congruent with your time horizon, risk tolerance, and goals. We've been doing this with you in our meetings. We'll continue to do that. It's very important. Regardless of what 2024 will bring, it is always prudent to watch your expenses and make smart money and investment decisions. We believe in proactive preparation, and our goal is to provide our clients with a solid financial strategy that is currently designed to withstand any market environment. A long-term strategy should always be the benchmark for smart investors. So let's take a recap of what we saw in the first quarter. Inflation is still elevated and a possible cause for concern, especially as it has moved up the last couple of months. An inverted yield curve remains. It's been stubborn, with short-term rates more attractive than long-term rates. We've been playing that for a lot of you, and that's why we're just rotating the short term. We're not going longer than 9 or 12 months because the yields just drop off. The Fed is still indicating we could see rate cuts late in 2024 now, not like they were saying 3 or 4 from June on. They're saying maybe none at all. There are several key factors that could bring a possible market correction. And remember, there's always a 20% chance of a geopolitical event in any given year. So volatility remains, and we don't think that's going to change for the rest of the year. So remember, a well-balanced portfolio should be designed to understand that volatility is always possible. Staying the course and maintaining the consistency of a well-devised long-term focused plan has historically served investors well. And now is not the time to throw caution to the wind. A lot of people are getting complacent. It makes me investment professionals, we still like to be prepared. Recent history has shown us that anything can happen. So once again, proceeding with caution should still be the principal notion for investors. We help clients create well-crafted strategies and plans that are customized to the unique situations and goals. Having a solid plan includes considering your time horizon, tax implications, liquidity needs, risk tolerance, and overall personal objectives. We've been talking with many of you on all this in our meetings for the last couple of months. The next couple of months, we'll be going into our second quarter meetings. This is why we're talking about this. This is why we're zeroing in on this and looking to the future. And remember, the economy's cycled, and we'll have another recession at some point. It's just a matter of when, not if. With that, we are very grateful for our clients and appreciate the opportunity to partner with you in your financial journey. One of our goals is to help more people just like you. The best compliment is an introduction. Some of our best clients referred to us by existing clients. If you know someone you think may benefit from our services, we would appreciate if you shared this video or added a friend to our mailing list. Or we would be honored if you provide us with their contact information so we can add them to our distribution list to receive our newsletters and invite them to watch or attend our presentations. Our next presentation, our next workshop is May 18th. It's estate planning and long-term care. If you know anyone that's worried about that, we're going to have a great guest speaker, great information. Please bring them. Let us know and bring those guys. Again, thank you for your faith in us. One of our primary goals is to keep clients informed, and we appreciate you watching this update. Please connect with me if you have any questions. Next week, I'll be leaving on vacation for part of the week, and then the following week, so about a week and a half, I'll be on vacation. But as always, Hector and Lacey are in the office and can help at any time. Thank you very much for watching, and have a great rest of the day.